Our exam's not until next Wednesday. So if you have any volunteers, you should have your exam question one essentially done. So if anyone wants to share it on Wednesday, I'll give your team a little bonus. We had one person do it before. And then next Monday, we'll probably do another tactical question to get prepared. I know there's going to be some students that are going to absolutely bomb the exam question one. Students think I want shallow and summarize, and I want depth. And it's not because I'm picky, it's because the depth I want is actually what you need to answer questions in interview. You really have to know it at that level. It really is that level of detail to understand finance. You make money in finance based on the details you know off the top of your head without looking it up. I've been speaking to so many alums. I spoke to one last Wednesday. He's doing infrastructure investing. We hadn't talked too much about infrastructure investing, but it's its own category. He works for the formerly USA real estate company. I don't know what it's called now, of Finney or something. I forget what it's called, but I didn't know USA did that. It's a unique area, but he's been doing that for a little over a couple of years, maybe, and his knowledge is so deep. The details he knows. That's how you get ahead in finance. It's get into those details. So be precise. Get into it. This should be a very long answer. If you haven't started yet, you're way, 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 way behind. You should have been drafting it already. So, but if anyone volunteers, yeah, I'll mock grade one on Wednesday so you can get some practice. So markets have definitely sold off the last couple of weeks, not as much as people think. So it's a correction. Y'all know the difference between correction and a bear market. So correction is how much? 10%. All right, a bear market's 20 from peak to trough. I do it based on closing prices. Some people actually go intraday, which can give you a really different answer. So correction is peak down 10%. So the S&P hit that last Thursday. It was down 10.3% from its peak. It's come back quite a bit since that, like 3%. So it has recovered some. NASDAQ down about 14% from peak to trough, and it's come back some since then. Small cap stocks, unfortunately, are down like 18%, and they've come back some, but they've really been hit. Value stocks have done really well. We've been talking about value stocks. Value stocks have done well this year. They're not positive, but they're higher than the S&P. And then the big outperforming this year is which asset class do you think has been killing it this year? Gold, definitely number one. And who's number two? Surprisingly. So developed markets, Germany, Italy, Spain, bunch of markets are up double digits this year. When the S&P is down 3%, they're up 14, 15, 16%. Just amazing. They've underperformed so horribly the last decade. This year they're outperforming. So it's been an interesting year. It was an interesting 2 weeks. The markets were worried about inflation, and then all of a sudden they're worried about recession. So you see that in the data. Obviously, they're worried about Trump and the things he's saying. They're trying to figure that out because he's kind of changing his mind backwards and forwards, and they're getting a little bit worried about that. I know Trump says he doesn't care what the stock market's doing. I don't believe that. I think he does care a bunch about that. I think if the market were to fall 20% or more, I think he would definitely notice it. I think the stock market hopes if they sell off enough, they'll get him to change what he's doing. So they're kind of hoping they may influence him. But we'll see. Who knows what the underlying plan is? But it's a tough time right now to be an investor. It's hard to make a strong argument for why gold is so high. If people aren't worried about inflation anymore, then why is gold so high? How much is the dollar sold off? Some, but not dramatically. So I think gold right now is just, there's so much uncertainty. People are buying gold. It's just a protection. So it's hard to say. This is a tough time to buy investments. I'm still sticking with, so early this year, we were pushing developed markets and small cap and value. So we got 2 or 3 of those right. Small cap hasn't worked, but value and develop has definitely worked. So it's been interesting. So we're looking at strategy execution, and so just what we're talking about is these major asset classes you're doing for exam one. Most of them have their own index that you can track. So if you go on the Bloomberg and you type IN in Bloomberg, that brings up every index Bloomberg has. It's an incredible function. And you'll get the tickers. Once you get the ticker for the index, you can then go into Excel and you can bring in all data you want to bring in on that index. One thing we're going to do in our dashboard team meetings this Wednesday, what they want to do is bring in all of these markets and bring in their price to earnings ratios and see which markets are trading cheap and which are trading expensive over time. So right now, we know emerging market stocks look really, really cheap. Small cap stocks look really, really cheap. Value still looks cheap, even though it's come back. Developed market still looks cheap. What looks expensive are the US large companies, the tech stocks. So we know what's cheap, what's expensive. Why can we do that? We can do it because each of these have their own index in Bloomberg. You can bring in prices, you can bring in PE ratios, you can bring in price to book ratios, you can bring in all kinds of really, really interesting information. You can do total returns, but you have to know your indices. But if you go on the Bloomberg and just type IN, it brings them all up, not just stocks, not just the US, every single index they have, including fixed income, gold, commodities, everything they have is in there. The ones you should know are the most popular ones. US large cap is not the Dow Jones, it's the S&P 500. It represents probably 85, 90% of the US stock market. It's it's only 500 stocks, but there's so many. You're talking about, $3 trillion firms. You got to have a lot of small companies that add up to 3 trillion. That's just one company, right? A typical small company stock is like 2-3 billion. You need 1,000 of them just to equal an Apple or Microsoft. So, they dominate these markets. And those mega 7 stocks, they're still about 30% of our market. So they're dominating. That's the large cap S&P 500. It's a market weighted index, which means the weights are whatever the market says the stock is valued. So if Apple is 5% of the market, it's going to be 5% of the weight here. Now, why did they do that? When they first did indices back in the 50s and 60s, they thought equal weight would be the right way to do it. If you have 500 stocks, put 1/500th in each stock. But the problem they discovered real quickly is that every single day you're out of balance. Because if you have 100 stocks, you put 1% in each one. Tomorrow, one's going to have 1.1%, one's going to have 0.9%. And so then how often do you rebalance? It got really, really complicated. So they actually thought equal weighted is the best way to go. But they finally went the market weighting. Why? Because you don't have to rebalance. If Apple goes up from 5% to 6%, that's what you want. That's what it's supposed to be. So market weight has become the standard. Equal weight actually outperforms market weight, and there's a good reason for that. You, as an individual investor, you could do equal weight, and you would probably beat most indices if you did that. But you can get away with that because it's not that hard for you to rebalance your portfolio. But when you have a $10 billion portfolio, you can't rebalance every single day. That gets really complicated. So it's market weighted is the most common. You don't have to trade as much because the market itself adjustments. The Dow, for some bizarre reason, is price weighted. We don't even know what that means anymore. So one stock trades for $50 and one trades for $100. You put twice as much in the one that trades for $100, which makes no sense whatsoever. Because how could a $100 stock suddenly become a $50 stock? Well, they could do a 2-for-1 stock split. Hasn't changed the value of the stock at all. They just have twice as many shares now, $50. So price weighted means nothing. You can change your price very, very easily without changing anything about the company. And what's more complicated is that the Dow index goes back and adjusts for all those stock splits. So the weights are no longer price weighted. It's price weighted adjusted. So it's so complicated today. I don't know how anyone follows. There are Dow Jones indices out there that trade as mutual funds, but I would never do them. Plus, there's 500 stocks in the S&P 500. There's only 30 stocks in the Dow Jones, so it's not nearly as well diversified. So I would stick with the S&P 500. Small cap, for some reason, Frank Russell cornered that market. So the Russell 2000 is still the one to go to. S&P, Standard & Poor's, does have a small cap index. They call it the S&P 600, and it is followed, but the Russell is just the more common. Now, Russell has a US large cap. It's called the Russell 1000. So the Russell 2000s, they're small cap, the Russell 1000s, large cap, but we tend to watch the S&P 500 for large cap and the Russell 2000 for small cap. But and then mid cap, the S&P has the S&P 400, but then Russell also has a mid cap. You know, they all have their own things. They also have growth and value. So there's a Russell 2000 value index. There's a Russell 2000 growth index. They have growth and value. So you have all different mixes and matches. The developed market, yeah, anybody know what MSCI stands for? What is MS? What major investment bank used to be is called MS? Morgan Stanley. This is no longer part of Morgan Stanley. They sold this off. So this is Morgan Stanley, but now it's just MS and it's their capital indices. How can a firm make money if all they do is indices? Well, you can make quite a bit of money. Every time a mutual fund puts S&P 500 on its title, the mutual fund, they have to pay S&P money. It's like at USAA, we had an S&P 500 index fund. We had to pay S&P money constantly, a lot of money. Vanguard actually got so irritated with it that they came up with their own indices, so they don't have to pay all these people all this money. So I would say it's a pretty good life. You come up with indices, people like it, they put on a mutual fund, then you're making thousands of dollars and you don't have to really do much other than keep the indices balanced. So that's how they make it. And that's what MSCI does, is they create indices. EFA is Europe, Asia, Far East, or something like that. Maybe it's Australia. I always forget exactly what the letters stand for, but it's developed markets, excluding Canada and the United States. So it's all development markets in the world except for Canada, United States. So it excludes North and South America, but there's only one developed country in North and South America, and that's Canada. So a lot of times you'll see EFA plus Canada. So they'll add Canada in to get you a little bit better diversified world. And it is a market weighted indice. And they break those between large cap, small cap, growth, value. They do all that as well. So similar type of thing. Emerging markets, MSCI again. They have an emerging market index. They probably have a frontier. Remember we talked about frontier markets? There probably are frontier indices out there. I've never looked at them. What's in them? I don't know how they perform. It would be pretty interesting to look at them, but there's their indices. And there's a typo. I mean, I need to fix this, but bond indices, it used to be Lehman Brothers, Lehman Ag. Barclays bought Lehman Brothers after they went insolvent. They brought their fixed income. And so then it was the Barclays Ag. And then I found out from Bloomberg that Bloomberg bought the indices from Barclays. So now it's the Bloomberg aggregate. So it keeps moving around all over the place. But now it's the Bloomberg aggregate bond index. There's a bunch of these bond indices. There's treasury indices. There's corporate indices. There's the entire market. So there's a bunch of these. There's by different durations, right? Long-term, short-term, intermediate term. So there's a bunch of indices, but the aggregate just brings them all together. The problem with the aggregate, so last time I looked at it, it was like 70% treasuries and mortgage-backed securities. If you don't own treasuries and mortgage-backed securities, if you buy the index, the aggregate, you're dominated by those. So, but that is definitely an index you can look at. So like I said, the original indices were equal weighted. And so they moved to the market cap weighted. Equal weight do give you higher returns with lower risk. How did they do that? Well, when you're equal weighted, you tend to be a value investor. Remember, value stocks are cheap. If you're equal weighted, you're going to be overbuying cheap stocks and underbuying expensive stocks. So you're going to be just automatically, when you do equal weighted, you're just automatically a value investor. So when value is doing well, equal weight does well. When value is not doing well, equal weight doesn't do well. So that you just have to be careful with that. If you're going to do equal weighted, you have to rebalance. Most papers say rebalance once a quarter. That's what we do at the portfolio we started with the Investment Society, which is doing great this month. It's just amazing. We rebalance once a quarter. And now the new thing that Robert Arnott pushes is fundamental weighted, which means don't make them equal weighted. Don't weight them by the market capitalization. Weight them by something else. Weight them by their revenue. Weight it by their net income. Find some fundamental factor, some accounting number, and that's what you're going to weight it by. And if you want to really, really understand this, go out. There's some great debates. Two of my favorite people, Robert Arnott versus Cliff Asness. Go out and watch these YouTube videos of these two guys. Factor fight rages on between Arness and Arnott. Just read what they're saying and see if you understand what they're saying, because this is where finance is. This is really, really cool stuff. Both of these are brilliant people. I've never met Asness, but I've met Arnott a couple of times. Got to speak to him at USAA. He came by. Both of them great, great minds, brilliant, brilliant people. Asness is known for writing really, really good articles, so you should read what he writes. Arnott is just extremely highly respected. These two people, they fight and fight and fight, but they highly respect each other. But they are having these public debates, which I think is really, really healthy that they do this. Arness does not believe in fundamental indices. Arnott is pushing them. And so if you really want to understand what fundamental weighted is, go read those debates, or go on YouTube and watch the debate, see what they're saying. That's probably by far the best place to go. Victory Capital used to be USAA. One of the guys used to work in my area, Lance. He started some fundamental weighted at Victory Capital. Sometimes they call it smart alpha. It's kind of a different way to do indexing. The issue with this is the exact same thing with equal weighted. You're going to end up with a value weighted portfolio. Anytime you weight anything other than market cap, you're going to end up with more of a value indice than a growth or core. So that's what Asness argues. This really isn't a different way to weight portfolios. This is another way to do value investing. I think I gave you the methodologies. I can't remember, but S&P and Moody's, they published their methodologies and how they put these indices together. Standard & Poor's is like 5 pages long. MSCI's is like 100 pages long, so it can go on quite a while. But interesting write-ups. So, certainly, I don't know if we've ever had anyone work for S&P or MSCI on the indices side. We've had people work for S&P. I don't know anyone working for MSCI, but I don't know if they hire finance majors. They probably hire mathematicians and IT people, because this is really a math job more than it is a finance job. It's this, how do you put these indices together statistically? Your job in finance is to know the major ones, but then also use these for modeling. So if you're going to try to figure out where do you want to invest, like Sebastian's taking my risk management class, they're going to do an efficient frontier. We're going to use these indices to build that efficient frontier, so we can build a model to say what's the optimal portfolio. So we use these a lot. You as a finance major, you need to know what they are, where the data is. So Bloomberg's a good source. Yahoo Finance used to be a good source, but it's not anymore. Yahoo Finance, they want to make money for a change. And all that stuff they used to give away for free, now you got to pay money to them to get that data. But you have access to Bloomberg, and you can dump all of these indices into an Excel spreadsheet in a nanosecond and do all kinds of analysis. If you're going to look at standard deviations, correlations, returns, you can do all of that. So you got to know which are the indices, where is the data, how to get the data so that you can use it, and then what to do when you get it. What statistics do you do? Which brings up the argument of active versus passive investing. Active investing, you're going to try to beat the market. Passive investing, you're just going to buy the market. Active investing is more expensive because you have to do something to beat the market. You got to collect data. You got to hire people to do the analysis. It's going to cost you more money. Passive investing is the cheapest. You just buy the entire market. I remember we used Barclays fund. It was a several $100 billion fund. They charged us practically zero. I think it was they charged us 2 basis points, so 0.0002. In fact, they visited us once with 3 people visited us from London. I'm thinking, we're paying you 2 basis points. You just spent more than that flying over here. Why are you visiting us? The S&P's up 10%, you're up 10%. Why do we need to meet with you? I was like, why are you even wasting our time? But yeah, they would visit around, but it's still pretty cheap. They had 3 people managing hundreds of billions of dollars versus someone else might have 3 people managing $50 million, so it's really cheap. But it's the cheapest way to buy, but you just buy in the market. So what you're trying to do with active is have a positive alpha. Your alpha is your return minus the market return. You want a positive alpha. There's one hedge fund that gave me a t-shirt. And the back of the t-shirt said, alpha is life, because that's what they're trying to do. They're trying to beat the market. They want positive alpha. So you could say that in an interview. So yeah, my goal is to beat the market. I want positive alpha. Those would all be sophisticated things to say. If you're going to try to find an active manager, or you're going to be an active one together, you have to have a process. We'll talk about that later in class. And I strongly encourage you, if you haven't built a portfolio, go out and do it. Don't put real money into it unless you have, a rich uncle or something wants you to have some play money. But build a paper portfolio. You can do it in Bloomberg. Just build a portfolio, monitor it, start doing that. Mainly so you have something to talk about in an interview that you've actually done it. The number one thing they're looking for in an interview is curiosity. Do you actually care about finance outside of the classroom? If you don't have a story to talk about what you're doing with finance outside of the classroom, you're in a lot of trouble in an interview. The easiest way to do that is build a portfolio in Bloomberg, monitor it. That gives you something really, really credible to talk about, even if it doesn't perform well. You're just learning. That's what we're doing in a dashboard team. We're building these portfolios, testing them out, seeing how they're doing. If you're going to hire someone to do this for you, you got to find someone with a good process. You hope they can consistently outperform, but no one does. Performance is extremely inconsistent, extremely unreliable. The overwhelming majority of active managers underperform passive indices because of fees. If you charge 1% and passive charges 2 basis points, you're starting off 98 basis points behind. So you don't have to just outperform, you have to outperform by 0.98 and then you're just tying. So it's really, really difficult to do. So 85, 90% of fund active managers underperform the indices, which means most people should just go passive. And that's not me saying that. That's Warren Buffett saying that. That's Jack Bogle saying that. That's Charlie Ellis saying that. Most retail investors should just go to Vanguard, go to BlackRock, and just buy a passive index. That's the smartest thing to do. I tell people I don't give investment advice, but if you're 20 years old and you went to Vanguard and bought the all stock index fund and just stuck your money in there, you're probably not going to be disappointed 10 years from now. If you are disappointed, it's because everybody's down. But compared to everybody else, you're going to be perfectly fine because the fees are going to be so low, you're probably going to beat 90% of the managers. So most people should be passive. So here you just buy the index. It's based partly on the idea that markets are really, really efficient. It's really hard to beat the market because people react to information so quickly. So there's something we got to cover on this. It's called the EMH, Efficient Market Hypothesis. There's a famous person out there. You can actually go out and watch him on videos. He's still alive. How to beat the markets. That's completely inconsistent with what he believes, and he's not going to say that. People make fun of him now because he's running a hedge fund. They're like, how can you run a hedge fund if you don't believe you can beat the market? He says, I'm not beating the market. He always explains it. He'll probably say it in this video. I'm not beating the market. I'm making risk decisions. This has higher risk and higher expected return, so I'm going to invest it for a higher expected return, but I'm taking more risk. So he believes if you're not beating the market, you're just taking more risk. And so I'm sure that's what he's going to say because he's fairly consistent with that. One thing you can do is in pursuit of happiness, no, of the perfect portfolio. Really, really good series. Dr. Lowe, great guy, Dr. Lowe, met him a couple of times, really, really good interviewer. But this whole series, In Pursuit of the Perfect Portfolio, I would watch all of those if I were you, especially right after this class, because it's just the perfect thing to put there. So he's interviewing Fama, and definitely going to talk about active versus passive. So Fama won the Nobel Prize because of this efficient market hypothesis. He's the one who came up with this in the 70s, and he's still around. And he was the PhD advisor to Cliff Asness that I just talked about. Cliff Asness's PhD paper was on momentum beating markets. He's like, I got Eugene Fama as my PhD who doesn't believe you can beat markets, and I'm going to propose beating markets using momentum. So it's an interesting discussion. But I don't know how old he is. He looks pretty young here, but I mean, he was doing major things in the 70s, which y'all seems like what, a million years ago. But he came up with this efficient market hypothesis. And what he was saying is, or asking a question, can you reliably beat the market as an investor? And he had two ways to talk about efficiency: information efficiency and fundamental efficiency. So information efficiency, he's asking how quickly do markets incorporate new information? And there he said it's like nanoseconds. A firm reports its earnings and the market reacts immediately, very, very, very fast. Not only that, but there are firms in New York City fighting to get like 100 yards closer to the exchange so that their trades get there a nanosecond faster than their competitors. That's how fast the reaction is. So their model gets the data, reflects it, does the trades, and they want to get there 1/1000th of a second faster than the next person. That's how fast we are in information. What chance do you have of information efficiency? How quickly do you respond? Pretty slow, isn't it? You probably don't have computers going the speed of light, putting trades in 0.3 seconds after the information comes out. So that's a tough one. The second one you might have some hope on, and that's fundamental analysis. What that says is all securities are always correctly priced at all time, or if there's any errors, they're random. So securities aren't overpriced, underpriced, it's just random errors. So if you have some model that actually can show that securities are mispriced, that's reliable, then you have an advantage. And that's what hedge funds are doing. You're competing against some pretty impressive groups, but that's the fundamental efficiency. So what Fama did is he broke his analysis up into 3 tests: the weak form, the semi-strong, and strong form. Have y'all had this in another class? This might be the only class you'll see this in. I don't spend much time on it. Some classes spend like the entire semester on it. I don't think it's as critical as it used to be. I do recommend you read, I just showed you Dr. Lowe interviewing Fama. Dr. Lowe has a really good book called The Adapted Market Hypothesis. I do highly recommend that book. He talks about this in that book. But the 3 tests, the first one, he called it the weak form test. And what he said is, if the only information you have is past prices, could you beat them in markets with that information? That's called technical analysis. And he said no. He said there's no support that technical analysis beats market. That's what you usually see on TikTok and those other places where they're pushing these models. You know, it's like, we got this model that always works. Give us some money and we'll make it work. And it does work really well. It makes them a lot of money because they're selling the models. But do the models actually work? They work sometimes, and then when they don't work, they blow up pretty badly. So, you know, they may look okay. But that's called technical analysis. There are mutual funds that do technical analysis. There's one podcast, and I cannot find it. The woman's name is Catherine something. I got to find it, but she did an excellent job talking about technical analysis. She's probably the most highly respected one in the business, so it's a good podcast.
You don't believe in it?
We use technical analysis, but it was just, if you look at technical analysis, I'm in the camp of somewhat what Dr. Lowe talks about, that what technical analysis are telling you is supply demand imbalances. So information's come out, it's really efficient, but supplier demand reacts quickly too fast. So demand reacts, but supply doesn't, or supply reacts and demand doesn't. And what technical analysis is telling you is when those things are out of balance, and it's going to tell you how they're going to get back into balance. I can see that. That makes some sense to me. It's mainly because you have different players. It has to do with the greed factor. A lot of it is institutional investors versus retail investors and how those two get out of balance. And that can tell you stuff. So
Have you seen that stat where it's like 70% of all trading done is by algorithms?
well, yeah, if you can get AI to come check, and that's maybe part of the problem here, is that AI is going to be a lot smarter at this than the actual technical analysts, because it's going to find the patterns much faster than the technical analysts. When I talked to technical analysts, it was kind of hilarious because I had a CEO that believed in it. And I shouldn't say this on video, but he wanted to prove to the exec council that it worked. So I put a slide up and he said, you can see, and he goes, oh, well, it doesn't work here, but yeah, show me the next slide. And he goes, see, oh, well, wait, it doesn't work there. And he kept, and it's like, it wasn't quite working for him. usually when I see people doing technical analysis, they pick the charts that work perfectly because that's what I want to demonstrate. And so it kind of it proves itself. But when I have people actually show me markets where they don't have any control over what slide, it's not quite so obvious to them. So yeah, I'm not a huge believer in it other than that supply demand. So I think technical analysis works really well to calling the bottom of markets because that's when the supply demand imbalance is the strongest. That's when institutional investors are buying and retail investors are selling. There you really see that indication. It doesn't work as well at the top of markets. I do think it's almost self-fulfilling prophecies because so many people are watching certain indices that when the S&P hits this 200-day moving average, everybody's talking about it. So that tends to create trades itself. But as far as it working confidently over time by itself, I don't believe that. Even algorithmic trading is not 100% technical. I mean, they do have some fundamental stuff in there too. So it could be, and then we'll talk about the fundamental side too. I think Fama's biggest evidence is he went with stock charts and then he created random charts and he took those to analysts and they couldn't tell which was random or which was an actual chart. And that's a pretty bad, if there's really something there that's not random, you should be able to tell what's random and what's not random. They couldn't tell the difference between the random ones and the actual charts. So it's tough. Dr. Lowe has a great book on technical analysis. Dahlquist, who was a professor here, she's got a good book on it. She makes the strongest argument that technical analysis is all about supply demand imbalances and coming back into balance. So you can certainly read her book. I couldn't make it all the way through her book, but the first few chapters are really good. I find technical analysis books to be a little tough. Or if I can find that podcast, that lady Catherine, really good podcast. She made a good argument for it as well. So, there's people out there I think make a strong argument for when it works and how to use it.
Is it Catherine?
Huh? No, it's a different one. No. She's not someone well known, but she's from the podcast. It's like she's the only remaining technical analyst consultant out there that people are going to, because so many of them have closed shop. But very impressive. I mean, when you listen to it, there's obviously she believes in her craft and she has data to support it. It's not like she's out there reading tea leaves or something. There's a process and a logic behind it. And that's one thing that's really important in technical analysis. You better have a underlying principle theory that supports it. That why does it happen? That's why I think supply demand gives you some reason why something might actually be there. So
do you use technical analysis after you're done with your fundamental analysis?
Well, to me, technical analysis is the entry point.
Yeah.
So I want to buy this stock. I think it's cheap. Oh, but it's about to break down. Let me let it break below this line and I buy it there. We used to do that in Investment Society. We learned real quickly, be real careful with round numbers, because if you use a round number and you're doing bid ask, you may want to say buy it at 45, and that may be the perfect spot, but you can't buy it at 45 because the bid ask, so you have to add some points because you're going to buy it a little higher. So we learn to make sure to do that. But you can set up your kind of your market trade based on technicals. Say, hey, if this says 45, buy it. Otherwise, don't buy it. You can certainly do that. We'll talk how you can do that even better with options. But yeah, I mean, you can say, wow, the RSI on this is really high right now. This thing looks overbought. I really like it, but boy, it's shot up too fast. Let's let it come back down below and let it break. So those things make some sense to me, because if there was an over enthusiasm for something and the stock got out of whack, so yeah, that's probably gonna come. I mean, like Tesla's a good example. Right after the election, that stock had no fundamental support. You couldn't justify, what was it, $1.5 trillion for Tesla. You couldn't justify that. Especially if you looked at it, their market cap versus cars sold, they were more valuable than every other cars company combined. So yeah, that's an overbought stock. I'm not going to buy it. I'm going to let it break down. So yeah, I think it does have its spot. Where we found it most valuable at USAA was in 2009. Technical analysis was screaming to buy in March of 2009, and that was the bottom of the market. And every single index, and they're all very different indices. Every single one of them would say buy. It was amazing. You don't get that at the top, but at the bottom, You really do. The smartest investors do start coming into the market at the right time based on fundamentals, and they tend to be pretty high volumes, but they kind of try to hide them. And you start seeing that at the bottom.
When you say you guys use technical analysis, are you using like an EMA or are you using like stochastic bands or what would?
We're using NDR. So I don't know if you ever used NDR. I don't know how to say cost. So it's all of that, but stuff they built themselves. I don't know if you can even actually put all their signals in every category. They're really, really good firm. Ned Davis sold the firm to somebody. And my understanding, I don't know about today, my understanding was he actually went and worked for them as an analyst, sitting in the cubicle, because he loves this stuff so much. Very impressive firm. I don't know if they show their charts in here. I mean, they have everything, but very, very impressive firm. So you could ask, how do small cap value firms do when the Fed is tightening? And 10 minutes later, they'll give you a chart and show all of that. And they'll ask you, do you like the chart? You say yes, then it becomes part of your, I mean, impressive firm. So they know how to get the data and manipulate it. But they do all the things you would normally think of. And they'll do it at the stock side or at the asset class side. They'll do US, non-US, they'll do fixed income versus, they'll do all the things you can think of. Bloomberg has a pretty good list of all of them by category, and you can look through those. Have you ever used the Bloomberg machine? You just type TECH and it'll list them all. So some of them I can't even pronounce. And I'm not sure Ned Davis even has titles to all of theirs. Supposedly, and I don't use X, but supposedly Ned Davis has an X account where you can get a lot of the charts for free. So you might look at them. They're the best ones I've ever seen. What I like is they send you the chart and they said if you were to actually trade on this, you'd be successful 62% of the time, and here's your average outperformance. And I think they give really good data pretty fast. So, but our main thing was momentum. So it's all moving averages. That's the main thing we focus in on. But then Ned Davis, I can't remember, it was 8 or 9 or 10, but they had, let's say it was 9. They had 9 signals that call the bottom of markets. And in March of 2009, every single one of them was saying buy, buy, buy. And they said they called us and said, we've never seen all of them say buy at the same time. So we were buying stocks. I mean, it was pretty amazing. But I'm sure they're very, very, very expensive. I doubt you as a student, I doubt they have a student fund, but and you always know they're expensive because their price is nowhere on their website. This isn't $42 a month. This is several $1,000s. I used to pay that bill back in 2009, but I don't remember what we paid them. So I'm not going to discourage you for technical analysis, but I would highly encourage you to read Dr. Lowe, read Dalquist. If I can find that podcast, listen to podcasts. Make sure you have an underlying theory for why you think it works, when does it work, so that you're not just kind of hopeful. So he said it doesn't work. That was his analysis. Dr. Lowe, who's highly respected as well, his book, Dr. Lowe, is a really good book on technical analysis. He says it does work, and he gives this argument for that. So you got these two major players in the finance world disagreeing with each other. So he does. So I do recommend Dr. Lowe's book on technical analysis. The second area he went into was the semi-strong. He said if you use all information that's publicly available, prior prices, their earnings reports, what management's saying in the news, if you use all information, all public information, could you beat markets? So you have technical analysis where you only look at prices, fundamental analysis where you look at everything that's publicly available. And his answer was no. There's no evidence that use of public information, people are consistently beating the market. Now, James Simons and some of these other people, it seems like there's some skill there, obviously. But his analysis, now remember, he's doing this in the 70s. I don't know where he got his data because the data wasn't available easily like it is today. But he said fundamental analysis does not work consistently. That word consistently is pretty important. So it might work really well in a stronger market, but in a recession, it falls apart. Or it might really work in a growth market, but falls apart in a value market. Or might really work well when tech's doing well, but might do horribly when tech's doing badly, you know. So essentially what he's saying is, yeah, fundamental analysis may not be adding value, but might just be measuring the people in the right market at the right time. And then when those markets go away, they underperform. So can fundamental analysis give you advantage in every conceivable market type? We have something we call junk rallies, which is really horrible companies with bad fundamentals do really well. That's a junk rally. You're probably not going to do well in that market if you're focused on value and quality and those kind of things. So it's tough. And I don't know, other than James Simons, any firms that have consistently, you know, you think about Bill Miller. What does Bill Miller do? Don't say barbecue. So there he is, Bill Miller. He is now with he keeps moving around. I thought he was over in California, but anyway, he's famous for having beat the S&P 500 15 years in a row, which is amazing because he is a growth manager. No, he's a value manager. Excuse me, he's a value manager, and he beat the market in 98, 99. How could a value manager win in a growth market? Well, he thought tech stocks were value stocks and he bought them. And then he sold out of them at the end of 99, and then the dot-com crash happened and he outperformed then. 15 years and you beat the S&P 500 15 years in a row, not be talented. Could you do that by pure luck? Probably not. Probably talented, right? I've heard him speak. His YouTubes are very good. He's a really good speaker. I think he is speaking really good stuff, but how did he do after those 15 years? Disaster. He had 3 horrible years. So was he skilled for 15 years and stupid for 3? Was he lucky for 15 years and unlucky for 3? Did the market change? You know, who knows? I think part of it was definitely luck. One reason I think Warren Buffett's so rich today is because he was right at the right time, made him look smart and got a bunch of money. I think part of it is luck at the right time. You have to be smart, right? Warren Buffett's obviously smart. Bill Miller's obviously smart, but then you have to be lucky, be smart at the right time. So then you get a reputation and you get a lot of money. So, but there he is. I don't know how much they show of his Leg Mason. That's the one I was thinking of. I don't know if he's still at Leg Mason. There's Bill Miller Barbecue, so that's not the one. They're not in any way related. You know, I don't really like Bill Miller Barbecues, so I'm gonna push theirs. So anyway, that's fundamental. So if you believe in fundamental analysis, make sure you have something that actually works. Make sure the process works, test it, criticize it, challenge it, because there's a lot of data out there that very few fundamental analysts actually consistently beat the market. They may have a few years there, but it's tough. I do think process is the most important thing, that they have some process that makes sense. It's logical to you. And we'll talk about it later, but fundamental analysis, you say firms with these characteristics, I believe are going to beat the market, and you got to come up with those characteristics. Got to be characteristics that make sense they would beat the market, that you can measure, that you can get. So you might say firms with high quality management beat markets. Well, that's fine, but how do you measure high quality management? There's no way to go pick that number off somewhere. So there's a lot of opportunities here for you to add value. What most people do in this industry is they learn one industry or one sector backwards and forwards. They just know those companies, and then they just apply that skill and that knowledge they have to that industry. Does that give them an edge? You would think it would, but still the numbers don't show that they actually outperform consistently. So it's tough. So Fama said neither of these work, but many of you are going to be working in a firm that I was working in a firm trying to beat the market. So it's kind of the norm. The last one was a strong form test. And he said he used all information, including non-public information. Could you beat markets? And this one, his answer was, I don't know. Because I don't know who's using non-public information because that's illegal. They're obviously not going to tell me. How could you test that? One way you could test it is look at when officers of a company suddenly sell a bunch of the company's stock. You would think they would have inside information, and you test those. And there are portfolio managers, that's all they look at is key person sells. So if a CFO normally sells 10,000 shares a year and suddenly she sells 500,000 shares, it's like, okay, why does she just sell 500,000? Oh, her daughter's getting married. Okay, that makes sense. But why would a CFO suddenly sell it? That's a terrible tax transaction. Why would they suddenly say, well, you think maybe she has some inside information on the firm and she's going to sell really fast. So that's the way he tried to test it. That's tough to do. Who's in the news right now for trading on inside information that makes everybody really, really mad? Congress, right? I've seen studies that show Congress, even with the inside information, are pretty horrible investors, but there's other people say there's some that are really making a lot of money off of it. It's legal for Congress to do that, which makes a lot of people really, really mad that they can interview in closed session and know that some firm's about to get a big government contract and go out and buy that firm before it hits the news. That should be illegal. And they've tried to make it illegal, but it's a tough one. Mafama says you really can't test this. It is illegal for us to use non-public information. But the question is it material or not? You can use non-material, non-public information, and that's legal. But you can't use material, non-public information. But how do you know if it's material or not material? That's what the jury's going to decide. So you're at the risk. So if you're sitting on the plane next to the CFO of Valero, and he or she says, wow, when this hits the markets, well, that's our stocks, and you're hearing all of this, can you go home and trade Valero stock? The answer is no, you can't. In fact, who's the first person you call when you get home? You call you say, Mom? You can't call your mom and tell her to trade stocks because that's still illegal. Whom do you call? You call your lawyer. What do you tell your lawyer? I just got material, non-public information. What your lawyer is going to do, your lawyer is going to call Valero and say, one of our investors just heard your CFO say this on the plane. You need to release this to the public immediately. So that's what you're going to do. What if you trade on it? Who's going to know? What's the SEC going to do? Oh, wow. Bill just bought 500,000 shares of Valero right before they know. Oh, and Bill is on a plane with the CFO. Wow, and the seat right behind the CFO. That's interesting. Our Bill didn't buy 500,000 shares, but his uncle did the day after he was on a plane next to, they're going to find out because that's what do you think they do when a stock price suddenly soars up 20%? They're going to go look who was the big trader before that hit the news. And they want to know, how did you know that? And could it be pure luck? Yeah, I mean, it's possible. What if you found 1 million pieces of non-public information and each piece was immaterial? Could you trade on that? That would be legal. So the immaterial, material, non-public information, when combined as material, that's legal. But if any individual piece is material, that's illegal. You can't trade on it. So what you have to do is you just have to talk to your lawyer, make sure it gets disclosed, and don't touch any trades on that because you spend time in jail when you do that. Just ask Martha Stewart. Some people don't like passive investing because they think it destroys the purpose of finance of allocating capital. It's called allocative efficiency. So if everybody's passive, then bad firms don't go out of business. Good firms don't do better. We need people out there constantly challenging. We want bad companies go out of business. We want good businesses stay in business. And that is true. Some people worry about that, but active investing is still the majority of the investing. It's 60-70% of the investing. Passive is not that big yet. So even then, it's probably not an issue yet, but there are people that worry about that. And then just one other thing on investing. Warren Buffett says you can beat markets if you're patient. So what he said is investing is like batting. but they never call a strike. So you just sit there and wait for the fat pitch. And that's what we're going to talk about Wednesday and then in the dashboard team. So we're going to say, can we bring in data so we can find the fat pitches? Which means we're not going to trade very frequently, but when that fat pitch comes up, we're going to go for it. That's what he said. What's the problem with that? Well, in my profession, I wasn't paid for making good investment decisions. I was paid for swinging. When you're paid for swinging, you're going to swing a lot. And that's how we're compensated. My boss was constantly, what are you going to do now? What are you going to do now? What are you going to do now? And the Fed just did something. I'm like, I'm not going to do anything. It's like, no, I'm paying you. You got to do something. So there's this incentive to do something. Because how can you be so stupid and not do anything? It's like, because I'm just as stupid now as I was yesterday. I still don't know what Trump's going to do. I still don't know what the Fed's going to do in this particular case. So yeah, I'm not going to trade on it just because everybody's panicking. But I think Warren Buffett's right. If you're really, really patient, there are ways to find some interesting trades. You'll probably get there early. Like I mentioned, small cap, value, and emerging markets look really cheap right now. I've gotten into the small cap and the value. I haven't done the emerging yet, but you could certainly do that and patiently wait it out. Probably 10 years from now, you'd probably be okay. But it's a patience thing. Is Warren Buffett a good investor? You should see the articles over time where he's a genius. He's lost his touch. Then he's a genius again. He's lost his touch. He's a genius again. And just back and forth with him. Why? He's a value investor. Value's not doing really well right now, although he did buy Apple, and that somewhat helped him out. But, you know, even though you're a great investor like Warren Buffett, you're going to have long periods of time where you're going to underperform. It's just the nature of the beast. All right. A few other issues on strategy I'm not going to spend much time on, but one is shorting securities, which is pretty unique to investing. That's your ability. You can sell something you don't own. So if you don't like Apple stock and your neighbor owns Apple stock, you can sell your neighbor's Apple stock. Now, your neighbor doesn't like that. So if your neighbor wants to sell Apple stock, what do you have to do? You have to buy Apple stock and give it back to them. But you get to short somebody else's stock. As long as your broker has the stock in their inventory, you can short it. You might sell it for $100. Hope it falls to 60. You buy it back 60 and you made all that money. So that's shorting. How much can you lose? There's no limit. So if you short a stock and it falls to 60, you made $40. But if it rises to 200, 300, 400, there's no limit how much money you can make. My recommendation is never short without a hedge. So if you're going to sell Apple stock at 100, hoping it falls to 60, I would buy a call option at 150 or something. So I would cut the top of that off so that I don't have unlimited loss. I don't like unlimited loss. I think it's really dangerous. So you borrow the stock from another investor. You have to put down collateral for that, some extra, and your broker's going to watch that real carefully because they don't want you going insolvent and can't pay them back. This entire thing is supported by the securities lending industry. It's an entire industry out there that just helps people borrow stocks to, well, actually, it helps you lend out your stocks and your bonds. So USA did that. Our mutual funds, we would actually lend our securities out and we'd make a little spread on it. There's actually some mutual funds like Vanguard. Vanguard might charge 10 basis points for a small cap fund, but they're probably going to make 12, 13 basis points lending out those securities. So you'll essentially get their fund for free. So in 2008, we got a bunch of nasty emails because we're lending our securities out. And at that point, people were worried that people were shorting bank stocks and causing the stocks to crash. And so people were telling us, stop lending out your securities. We're like, no, we're going to keep lending out our securities. It benefits our investors. We're going to keep doing it. We're not going to do it because you're worried about bank stocks. But it's an entire industry. You could work in this industry. I think Al Gore, y'all probably don't remember him, but Al Gore, vice president, almost became president. He actually, after he lost the presidency, joined a securities lending firm. That's before he was doing the global warming stuff. So it's an industry that's out there. You could make this your entire career you wanted to, but that's what they do. They go out and help firms lend out their securities so they can make as much money off the lending as they can. And then if you're on the other side of this, if you're shorting, you're selling those securities. So there's actually an incentive to be on the side that's lending out the securities for you to short, because you make a little extra money when you do that. So with shorting securities, that's what our current portfolio and the investment society is doing. We're buying 6 stocks and we're shorting 5. And so far, it's worked really well. We're 6 months into this. So we turned $1 into the day I looked, it was up to $24,000. We turned $1 into $24,000. So it can work. And it even did really well the last few days when the market was down, because if you're short and long, we're long and short, the market can be down, you're fine as long as the stocks that you're long on fell less than the stocks you're short on. And that's what happened to us. I think I told you a few weeks ago when Nvidia fell 17%, I was like, oh no, we're long Nvidia. But we actually made quite a bit of money that day because we were short Broadcom and it fell more. So I was like, fine, we're good. So we kind of matched them up. That's called paired trading. So we made sure if we're long a semiconductor stock, we're also short a semiconductor stock. That way, if the whole industry crashes, we're still probably okay. Because what we're long on went down 10%, what we're short on went down 20%, we're still fine. And you can actually do it in a market neutral way. That was our goal, is to make our performance completely unrelated to the market. If the market's up 5%, we might be at 1% or down 1%, completely unrelated. That's called a market neutral. Essentially, it's a beta of 0, so you're unrelated to the market. And that's kind of our goal. So you can do that with shorting securities. Some firms aren't market neutral. They might be long 130 and short 30. So it gives them some ability to balance their portfolio a little better. There's other approaches for shorting securities. And there are some people who just short securities because they don't know better. And it just amazes me. I was on the phone at USA. We had a sit-in with the phone reps as they talk to customers, so we would understand what's going on in our business. And I'm what they call whiteboarding. I'm listening in. And they were talking to this one customer, and she mentioned to the customer, you know, you're short this stock. And she goes, oh, I forgot about that. I just nearly screamed into how can you forget you shorted a stock? That's insanity. That's a very risky trade, and you did it, and now you forgot all about it. And the representative was like, quiet, you're messing up my call. It's like, how could she be that stupid? I was like, no, we don't tell our customers. But yeah, she had a shorted security and forgotten that she had shorted it. That is not a smart move. This is very dangerous stuff because there's no limit to what you can do. But if you do a paired trade, you at least protect yourself from a major blow up. So especially if you're short on a stock that goes up 20%, if you're long on a stock that maybe goes up 18%, at least you protect yourself some. It wasn't a complete wipeout. So I would do paired trades. Paired trades mean if you're long on something or short on something, you match it with something in the same industry, a similar type of stock. In Investment Society, we did some paired trades. Once we bought Walgreens and sold CVS. This was several years ago, and that worked out really well. The reason we did that is those two stocks moved together, but then suddenly they went like this. CVS went up, Walgreens went down. So we shorted CVS, we bought Walgreens, and then they came back together. We made a lot of money. So that's a paired trade. We did a few of those. Yeah, they can work. Buying on margin is essentially you're borrowing money to invest in the stock market. If you took my risk management class, we talked quite a bit about that. And borrowing money to buy stocks is, again, a very risky thing to do. But what it does is it leverages up your returns. If you borrow 50%, invest in the stock market, you're just going to double your returns. You're going to double your losses. You can buy on margin with your broker. You have to look at the rules are and how much you can do and follow the rules real carefully. They're obviously going to watch your account very, very carefully because if things blow up, they don't want you owing them money. And so they're going to have cash calls. They're going to make you have to deposit more money if things blow up. But it just exaggerates both your gains and your losses. So just be aware of that. I won't go through the numbers. So any of y'all do margin trading or shorting in here? Have you had any successes or blowups, or do you shorting or? Yeah, we'll talk about options later. Yeah, options is a way to leverage where you have a lot more downside protection. If you're buying, if you're selling, you got a lot more upside risk. But we'll talk about options. Yeah, options is a lot of stuff we're talking about. Options can often be the better way to do it because you can really structure it in a much more risk adjusted way. All right, let's talk about expenses with investing. So it depends with expenses if you are a large investor or a small investor. So it used to be used to get charged commissions. Then Robinhood came along and started doing free trades, and then Schwab and Ameritrade, everybody else started doing free trades. Not everybody, though. I was working with a group that wanted to use, I think I told you this, want to use Frost as their brokerage. And so I called the woman at Frost and send me your brokerage account. And it was a brokerage fee schedule from the 1970s. It was horrendous. I could not believe how horrible it was. So we did not, I signed up with Schwab. I used Schwab. I always thought they were charging $50 a trade. That's what they charged in the 70s. $50. And why would you pay $50 for a trade when you can do it for free? It just makes no sense whatsoever. It's really, really bad. So some banks just are not in that business. So essentially we're free now. What you have to pay is the bid-ask spread. So the bid-ask, we're going to talk about that later, but if you're buying something, you're going to pay the ask, which is the higher price. If you're selling something, you're going to receive the bid, which is the lower price. At USAA, when we did transactions, we generally got in between the bid asks. So we essentially got something pretty close to the actual price. We got pretty good. So for big investors, the bid ask is not that big of an issue. They usually get better get execution. You as a small investor, this is probably your biggest expense of trading is the bid ask. So when you buy something, you pay more, and you sell something, you pay less. If the bid ask is really, really wide, it's probably a very illiquid security, and just be very, very careful on those type of trades. They can be quite dangerous. So watch that bid ask spread. But that's what you, as a small investor, it used to be commissions, but no longer. Now what you're paying is the bid ask. And that's how the person, the market maker, that's how they're making their money, providing that liquidity and taking some risk. If you're a large investor, your biggest cost is market impact. When you trade a large block of stocks, you can actually move the market because you overwhelm it with supplier demand. And so I had to deal with this at USAA. If I'm going to trade $1 billion, it's, well, a big number. $1 billion is not that big anymore, but $1 billion trade. There's a few trades I did where $1 billion could have moved the market. So you're thinking, okay, how can I do this trade so my trade doesn't change the market? Can I hide it in some way? And so that's when I would hire someone to help me, called a transition manager. What the transition manager is going to do is find every way to trade those securities without it impacting the market. My favorite was these match trades. So you go to State Street and Vanguard, and these are these big index firms. They're doing major trades every day. And you go to them and say, hey, I need to sell 1 million shares. You're buying 1 million shares. Why don't we just trade our shares and we'll just trade at whatever the closing price is? So yeah, that sounds good. They don't have market impact. I don't have market impact. We're happy. So we do match trades. You can get a lot of your trades done with match trades. So as much as you can do that. After that, you start trying to hide your trades. You break them into smaller pieces. You try to do it in a way that markets don't notice. But that's what a transition manager does. Usually if you're trading hundreds of millions of dollars, you can at least talk to your transition manager just to make sure you're not gonna get killed. Because if you trade 1 million shares and that causes the price to fall 5%, you just lost 5% just because you traded, because you overwhelmed. There weren't enough buyers out there to buy the stock. Trade volume is really critical for that. So stocks with low volume, if it trades 50,000 shares a day and you're trying to sell 1 million shares, that's going to drive the price of that stock down. So that's where you got to be really, really careful. Small cap funds especially have this problem, and they'll tend to limit the size of their portfolio so they don't have that problem. They'll try not to become a $10 billion fund because it makes it really hard to trade. A good friend of mine was a transition manager at Credit Suisse. I never used him as a transition manager. He was always pushing his product on me. He was pretty well known. There's a transition manager magazine, and his face was on the front of that thing at least once a year. Pretty well known. I haven't heard from him in years. He went to India and started a hedge fund. I don't know how he's done. an energy hedge fund, but he started off as in fact, he started off as an actor in New York. That didn't work, so he became a transition manager. So if transition manager doesn't work, you can try acting or one way or the other, or somehow he got into finance. And that was his thing. So again, you talk about finance, you specialize. He decided to specialize in transition manager, and he made his entire fortune just doing that. But that's his job, is to help you do major trades in a way that you don't impact markets. And if you hire a manager, you have portfolio management fees. We've talked about this before. That's probably the most important thing to look at. If you're trying to pick between 4 funds and you're not sure which one you want, just pick the one with the lowest fee. That's the easiest thing of all. That is the most predictable thing how funds do, is their management fee. So that one's pretty straightforward. Don't do front end or exit loads. There's no evidence that firms that charge higher fees do better. They're not charging higher fees because they're better. They're charging higher fees because they can get away with it. Just think about Tim Duncan. Tim Duncan, he could have handled his own investing, but he didn't have time. And I wish I had emailed him back then and said, I'll do everything for you for free. Because he was of the thought process, which makes some sense, I think, is, hey, I'm a rich guy. I got all this money. I should hire the best in the business. Obviously, they're going to charge the most. So that's what he did. And he ended up getting defrauded by his portfolio manager and having to sue them. So I wish I'd say, hey, Tim, I'll do it for free just so I can say I'm helping Tim Duncan. I would have just stuck in a bunch of Vanguard funds and he'd be a lot richer today than he ended up being. What his fund manager did, his fund manager had some really bad investments. And so he got Tim Duncan's money and essentially sold his bad investments to Tim Duncan so he could get out of them. That's how he handled Tim Duncan. And Tim Duncan had a really good case against this guy. The problem is, what happens when you sue a guy who just defrauded you? It's a good chance they don't have any money to pay you back. So I don't know how you got out of that, but yeah. So right now I have an NBA player who's texting me. He's a former UTSA student, and I'm hoping I'll do everything for you for free. He's not quite as famous as Tim Duncan, though, but he did play 31 minutes last week, so he's getting some time in there. So I don't know. There aren't that many NBA players texting me, so I have to go with him. But he was a star at UTSA. He was a really good player, and he's doing that. So if he gets a $1 million, $2 million contract, I'll say send it to me. I'll do it for free. Hopefully he won't be suing me a few years later. All right. So that's strategy. I would try these kind of things, test them out, build stuff, buy mutual funds, buy individual stocks, set up portfolios, do some trading, try options, try futures, try these kind of things, get some experience just so you're ready for the interview. They want to hear you say those kind of things. So, oh yeah, I set up this portfolio. This is my theory. They don't have to agree with what you're doing. They just want to know you're thinking. There's so many finance students that are so bored with finance and they're 22 years old. And it just like depresses me. It's like, you're going to be doing this in the next 50 years of your life and you're already bored. You can't be like that. I mean, USA invited me to a dinner party and I'd already been retired for several years. And I arrive at the party within 5 minutes. All the finance people were in the living room talking finance and all the spouses were in the kitchen talking whatever. And the spouses were like, don't y'all do this all day? He's like, yeah, we do this all day. We're going to keep doing this all day. That's all we talked about. What's the Fed doing? What's the market doing? The entire night. And the spouses were like, this is so boring, but that's what you do. This is your life. So prove to the employers, this is what you're interested in by doing stuff outside of class. So, all right, we're going to talk about return and risk. This is an important math question on the exam, the second exam, not on the next exam. How do you calculate return? How do you calculate risk? So return, we're going to use a simplified approach for calculating a return. This is not the approach the CFA Institute allows. They require the modified DEETs. If you want to look at modified DEETs, there's a good Wikipedia page that shows you how to do the calculation. I'll show it to you. The biggest difference between what I'm showing you in modified DEETs is cash flows. If you buy or sell a security, the formula changes quite dramatically. All right, so the reason for that is there's a difference between Show you all this. This is pretty important. There are time-weighted returns and dollar-weighted returns. Those are the two ways to calculate returns. Dollar-weighted returns is the exact same thing as IRR. It's what return that if you took all your cash flows, what return would get you to your ending portfolio? What was that return you got? So timing of when you bought securities, when you sold securities, that's dollar-weighted return. Time-weighted return is a return taking out the impact of timing of purchases and sales. Time-weighted returns is saying, hey, you bought $50,000 of stock on Tuesday, and then the market fell 10% on Wednesday. That was a really bad timing decision. That's going to really hurt your return. Your dollar-weighted return is going to be really hurt by that. You would have a lot better if you waited and bought the stocks the next day when after market fell. Dollar rate return, this is your true return. When I calculate my portfolio at home, I use dollar-weighted returns. That's how I calculate how I did. But this is how the industry standard. The industry uses time-weighted returns. Why? Their argument is they don't control when you buy and sell stuff. So the fact that you bought their fund on Tuesday, that's not their fault. The fact that you gave them $50 million more on Tuesday, that's not their fault. So what they're saying is, hey, the timing is your decision. We're going to take that timing out and we're going to calculate the returns, excluding your bad timing decisions or good timing. We don't get credit for your good timing decisions. We don't get penalized for your bad timing decisions. Jack Bogle showed that dollar-weighted returns or time-weighted returns, he said, were 40%. And over the same period of time, dollar-weighted returns were 0%. 40%, that's the returns the industry reports, taking out the timing of their investors. 0% is what they actually earned. Is there a difference in those two numbers? Pretty big difference. The industry advertises this, their customers actually earn that. What is the industry saying? Well, not our fault. They're not making any money, but that's their fault. They're trading really badly. My argument is the industry actually influences the timing investing quite a bit. Because what does the industry do? They advertise their funds that did the best. They push their customers in to do what? Buy highs, sell low. Because they push the stuff that's working, that's what their customers buy. So I think the industry does influence the timing of investing because of how they advertise. Because they don't advertise based on what's best for the customers, they advertise based on what they can sell. As Warren Buffett's, no, not Warren Buffett, Jack Bogle says, we're not investors, we're marketers. So I think the industry does have a big role to play in that huge difference between those two returns. But the industry gets to take all of that out, which they love because it has a huge impact, makes them look a lot better than they really are. It's pretty sad though, when you tell people you're making 40% and they're actually only making 0. It's pretty sad that those are the differences. All right, we'll stop it there, but we'll start here on return. Any volunteers for exam 1, question 1? Let me know between now and Tuesday or Wednesday. All right, the second thing to cover, I will put this on Canvas. I don't think you're going to worry about paper 2 until after the exam, so I'm not too eager to get it all done, but I did create some companies. I didn't put them alphabetically, but you can look through it. So like Marvel is in there, Adobe. So if you look at it, what do I give you? So I give you earnings per share, revenue, gross margin, and at the very end, I give it EBITDA margin. So you've got those when you talk, and so I'm giving you what you actually would talk about in a paper like this. All right. So these are the components you definitely talk. If you read articles on your company, you're going to see exactly these kind of things. So when you get the paper too, we'll do more of this, but you can say they reported 413. I mean, they reported 508, excuse me. So the reported versus the comp. The reported is the actual gap number. The comp is what the market's focused on. That's the comparable. So they reported 508. The market was expecting 497. You notice the actual gap number was really low. So what you'd actually do in the paper is you would say, Adobe reported $4.13, parentheses, 508 after adjusting for. All right. And then the 508 is all you care about. The comp is what the market's focused in on. Okay. Pretty big difference though, isn't there? And there normally is a big difference. So there's something Adobe's doing. It might have to be to do with they're doing their amortizing of certain thing. They're amortizing maybe something that's just causing their earnings to be really low. And the market says, we don't care about that. That's non-cash. It's pretty consistent for them that they're different. But you'll notice this surprise is based off of the comp and the estimate. So you mentioned the 413 once and you never talk about it again. The entire rest of the paper is on the 508. Right? That's why I highlighted it in purple. So you'll talk about the comp versus estimate. You'll also talk about the comp versus the prior year. So they beat estimates by 2% and they're 13.4% higher than last year. That's what you'll see in these articles. Right, so Adobe reported $4.13 in earnings per share, parentheses 508 after adjusting for the amortization of whatever. This beat the estimate by 2.717% and was 13.4% higher than the same quarter last year. And you notice we do the same quarter last year and not the previous quarter because of seasonality. You go back a full year. And then on revenue, you do the exact same thing on revenue. You notice here, there's no adjustment on the revenue, which is pretty normal. You will see some. So here you say they reported $5.7 billion in revenue, which is 0.94% higher than expected and 10.3% higher than last year, same quarter last year. All right, revenue is pretty straightforward. Gross margin, they reported a gross margin of 90.38, which was what? I should have put this in the description. What is that, 45, do you think? 45 why? It's not 45%, is it? 45 basis points. Why are we using basis points? Because these are percents. Anytime, I should have put the word basis points up, but these are in basis points. So you can say they reported a gross margin of 90.38%, which was 45 basis points higher than expected and 37 basis points higher than the same quarter last year, right? And you'll see that in the articles too. They'll talk about gross margin being 50 basis points higher or whatever. You don't necessarily need to talk about EBIT. You can, but the only reason EBIT's here is so we can do the EBIT margin. EBIT margin is your EBITDA is your EBITDA divided by revenue. So their EBITDA margin was a ridiculous 51%, which is here I did put the basis points in there. I have to go back and fix this. Let's see if I can do it. Yeah, I don't know how to spell concatenate. Concatenate. Let me see if I can I probably can just copy it from here. Yeah, there you go. All right, I'll fix that. So it should be basis points. I did put it in there. I just didn't do it. Yeah, I just didn't do it there. Yeah, I'll fix all of these before I put it out there again. All right, so in basis points, some of these basis points differences are massive for some of your firms, like 1890. That's when it gets a little difficult to write it because that's just a ridiculous number. You know, their margins are their EBITDA margins up 1,890 basis points, but that's what it is. That's 18.9%. That's just the nature of the business. All right. So you'll write about each one of these, and then what you have to do in your paper is explain it. Why did they beat? Why were they lower? Why was it higher than last year? That's where you're looking for articles to help you explain this. The one thing I haven't done yet that I still need to build other than fixing the basis points is I'm going to give you a chart of the stock price and how it performed, and I'll give you some comparisons. I can find a good one. So like here I have Sprouts. For Sprouts, I'll show you
how Sprouts did on the day they released earnings. I'll show how the S&P did on that day. I'll show how consumer staple stocks did on that day. And I might show how other grocery stores did on that day, something like that. I'll find some ones to bring together. What you really should do, that would be much more valuable. I used to do this, but I've stopped doing it just because it's hard for everybody to get to the FSC. But what would be really, really cool is you've got the FSC, if you could build this entire thing yourself. I do a video that shows you how to build this and get all the data in, but you need to be able to know how to get the data in. So it took me a couple hours to get all these in. I gave you quite a few companies. If you can't find a company you like, I'm hoping the entire class doesn't do NVIDIA, but I do have NVIDIA in there. I mean, a ridiculous thing on NVIDIA is their revenue. Their revenues are up 78%. I mean, that's just crazy. Their revenues this last year were, it doesn't show it to me. I don't know why. So their revenues this last year. Why is it not showing it to me? That is bizarre. I don't know why it's not letting me sum. Did I just type it wrong? Yeah, I don't, boy, that is really bizarre. But anyway, their revenue, you may know what I'm doing wrong. Is Bill Gates in the room somewhere? So their revenues this last year, $130 billion. 10 years ago, their revenue was $4 billion. This is a fast growing company. So, boy, that was really, I'm sorry, I'm distracted now. I don't understand why we can't have a summation. Anybody know why it's doing that? I've never seen that. Wow. Right. They are numbers. That's really, really bizarre. Okay, sorry. No, I'm intrigued what Bill Gates is messing up. So if there's a company you wanted to do this on the list, what I was looking for were companies whose stock price moved a bunch. And so I went into, and you used to be able to do this as well. I went into the EBTS function in Bloomberg, had it bring, I did the Russell 3000, so a bunch of stocks, had it bring in all earnings reports the last month. And I brought in, I had to do a formula. And we're in the dashboard teams, we showed you how to do this. So the formula looks and sees what day was the earnings released and at what time in the day it was released. If it was released after close, it looked at the stock price tomorrow versus today. If it was released before open, looks at today's stock price versus yesterday. So I have all that in the formula, and I just sorted it by the biggest stock moves. And these are the companies I came up with. Have y'all seen any firm out there you'd be interested in doing? I'm interested in this firm. When I drive by Starbucks, there's 2 or 3 people in line. When I drive by Dutch Brothers, there's like 10 people in line. Have y'all noticed that? What does Dutch Brothers have that Starbucks doesn't? Is it cheaper, or is it, because it looks pretty basic coffee? Do they have?
It's the same. I think price wise it's the same, but I think they have like more variety.
Oh, more variety, really?
Like their menu is more spread out than like Starbucks. You know how like Starbucks you can make like a frozen drink, but you would have to like ask them to make it. They have like already like preset drinks already there.
Now, are they fast? And
yeah, they're pretty fast.
because that's always my problem with Dairy Queen. Dairy Queen has all those options, but their people are so slow because it's just too much stuff, and you can overwork these people. But yeah, I mean it's Starbucks has been struggling of late. So what is Dutch Brothers doing? Obviously, it's much smaller than Starbucks. But if I did Dutch Brothers, I might compare their stock price to Starbucks on that day to see, what's going on with these two. But it's interesting. I don't drink coffee, so I don't know how to compare them. But their earnings are up 75%. They beat by 367%. Their revenues are up 35%, which is just amazing. Their margins are not too particularly good. Retail 14% margins they're not horrible, but it's not particularly good, but it's decent margins. But yeah, I mean, it's an interesting firm, so. The challenge with using Dutch Brothers is because they're so small, you may not be able to find as many articles. But one thing we showed, and this is the other thing in Bloomberg, that's why I say you can do this entire paper on Bloomberg. If you type their ticker and then type GP, which is graph price, when you go in the graph price, if you click on key events, all these articles will come up on Bloomberg about their earnings release. And so you can just go right into Bloomberg and click everything you need is right there. But you'll be able to find other articles out there. Bros, I got a pretty cool ticker. I don't know when they released earnings. We can look here. It's hard to tell here because I don't have the time that they released, but it's somewhere around either the 12th or the 13th. Remember, the way you can tell if it's the 12th or the 13th is look at historical data. This is February. So which do you think it was, the 12th or the 13th? It's definitely the 13th, right? So they were released on the 12th, but it must have been after hours. How can you tell it's the 13th? As the volume shot up to 14 million shares. So that's how you can tell which day you need to be looking at. I'll get you the right day when I pull in the data, but they must have released after hours on the 12th. And look at what the stock price did. That's a pretty good jump. So on the 13th, can you see it? Now, your problem is you only get to talk about this day. Granted, it's come back down, but you don't get to talk about that. It's as if you're writing the entire paper on the 13th. Okay. You can talk about the close. Usually you do this paper first thing in the morning on the 13th. Or you probably would have written it on the 12th and looked at after hours. So the fact that it's come back down, yeah, that's kind of bad, but there's a jump. You're writing about this. You can find articles out here, recent news. Eight days ago, you're going to have to go pretty far back. So that's why I mean, you can find it, but you're probably gonna be better off on Bloomberg because again, Bloomberg can go to the news on that specific date. So there probably would have been an article there, but anyway, interesting stock. All right. I wouldn't worry about this until after the exam, but this is what you can work on. This is a paper you can easily do in a week and get it turned in. It's not a terribly complicated, difficult paper. So I'll fix some of the things, get but again, I think you're far better off if you can do this entire thing yourself and don't have me build Excel for you. But I started building Excel because of COVID and I just got in the habit of doing it. So, all right. All right, so let's get into, and that's a good paper to put on LinkedIn. It's a nice crisp paper, shows that you can write, you can do research, you can look stuff up, you can answer questions. So that's the kind of thing they're looking for. All right. So we're calculating return and we're going to do a time weighted return, but we're not really going to adjust for cash flows like the modified Dietz does. So our return, our value formula, it's a really simple formula. You don't get formula sheets on the exam, but it's a real simple formula. Your ending market value minus beginning market value plus any income that's accrued divided by beginning market value. With bonds, this accrued income gets really complicated. If you took an accounting class where you had to use the interest method, the accrual of the income can get really complicated, but we're not going to calculate it for bonds. We're only going to do stocks. What's the only income we get on stocks? Dividends. All right. So when do you accrue the dividend? So you have 3 dates. You have announcement date, X date, and payment date. Modified Dietz is focused on the payment date, but this accrued income, make sure you have this as in notes. All we care about is the X date. That's when we accrue it. The X date, the way the X date impacts you as a stock investor. If you buy a stock and you own the stock on X date, but you sell it before they pay the dividend, you're gonna get that dividend. Whoever owns the stock on X date gets the dividend. All right, so that's why you accrue it. X date tells you it's your dividend and you get to keep it, all right? So that's critical. On the exam, I give you announcement date, X date, and payment date. Ignore everything but X date. That's the only thing you need. So if announcement date was January, X date was February, and it paid in March, you're gonna put the income in February. Okay? Everybody see that? It's really straightforward. So, and you'll actually see the stock price fall on X date. Because what they're saying, hey, this company's out to pay out $1 per share. So the value of the firm's going to come down because they're committed to pay out $1 per share. They're not going to have that cash anymore. So it's going to fall $1. But if you have the stock on X date, you're going to get the $1. So the stock falls $1, but you're going to get $1 in income. It's a wash. So essentially, the value of the stock doesn't go up because you're paying a dividend, because yeah, you get $1 per share, you get $1, but then the firm's worth $1 less because they just paid out $1. So that's how that X dividend works. So for stocks, what you're going to do is ending market value minus beginning market value plus dividends on X date in the month that they do the X date divided by the beginning market value. We're going to be doing this monthly. So ending market value is the last day of the month. What do y'all think beginning market value is? Is it the beginning of the month or the end of the previous month? Which would you think? Yeah, the end of the previous month, right? So beginning market value, if you're doing February, it's going to be February 28th minus January 31st, divided by January 31st, okay? It ignores purchases, dividend dates, all of that is ignored in my formula. This is a simple formula. In reality, with modified deets, which is the time value, you have to put all those in there. So let's look at modified deets just real quickly. It looks similar formula. So they have B minus A. So B is the ending market value, not beginning. So B minus A is the same. This F float looks like they're subtracting income, but it's not quite that. What they're doing is they're taking out cash flows. And the reason they're taking out cash flows is your ending market value. If you bought a $50 million in shares, your ending market value is going to be $50 million higher. So you're taking that out, so that's not impacted. But then in the denominator, you're taking beginning market value, but then you're bringing cash flows in on a weighted basis. So, if the dividend paid on the 2nd of the month or the 5th of the month or whatever. So you're probably glad we don't have to do this. When we, in our portfolio for the Investor Society, we had modified deets in it. I hated it because I had to perfectly time every single cash flow. Purchases and sales wasn't a big problem because I had to put that in anyway, but the dividends, I had to put the exact date of the dividend in there. So we're not doing modified deets, but it is a time weighted. I don't know if they say that in here. Let's see. Yeah, linked return versus time weighted. We'll talk about linked returns as well, right? So this is a time weighted. So what we're calculating here is the holding period of return. We're calculating 1 month of return. So on the exam, you have to calculate 3 holding periods, 3 different months. We'll see, we'll be doing some team exercises practicing that. We'll probably do that today. So the holding period can be daily, can be weekly, can be monthly, can be annually, but we're going to do monthly. That's the most common. Once you get the holding period, you're then going to link those holding periods together to look at something over time. And I wish we could do the exam in Excel, because then I could give you 20 years of data and you could calculate the returns. I'm only going to give you 3 because we don't have enough time to calculate that many points. All right. Once you get holding periods, you're then going to be doing some averages. So there's arithmetic average and there's geometric averages. And we're going to annualize those averages. All right, so this is really, really critical to know, especially if you're interviewing to understand this. You already know arithmetic averages. That's real simple. You got 3 numbers, you add them up and divide by 3. It's just a basic average. That's the arithmetic average. The geometric one is the one that's more complicated, and that's where you have to actually link them together. All right, so the arithmetic average, you just take monthly and divide by the number of months that you have. If you have 20 months, you divide the number of periods. Here I say by 12, it assumes you have 12 periods. This is for annualizing. So so if I give you 3 months, you divide by 3. If I give you 6 months, divide by 6. And then to annualize it, you multiply by how many periods there are. So if you're doing monthly, you take your months, divide by the number of months, and you multiply by 12 to get an annualized number. All right. Arithmetic average is what we call the expected value. It's the number, if you're forecasting the future, you would use the arithmetic average. Okay. The geometric average is a much more difficult calculation. You have to take 1 plus the first period, all in parentheses, times 1 plus the second period, all in parentheses. You keep doing that over and over again until you run out of periods. And then you take that to the 1 over the number of periods minus 1. And if you don't know this formula, learn it now forever and ever and ever. You use this formula a million times in finance. I'm literally, in my lifetime, I'm sure I've done this more than 1,000,000 times. I can't imagine how many millions it is, but it's a formula you as a finance major know backwards and forwards. Have you heard the term CAGR, compound annual growth rate? Let me show you a CAGR, because this is really, really critical. So this is the consumer price index. I'm going to take it into Excel. Let's see, we wanted to know what the average growth rate and inflation was over the last several years. So let's do number of periods. Do y'all know how to do CAGRs? I'm going to tell you something you already done. Who does CAGRs in here? Anyone not know how to do a CAGR in here? A few of you. All right, so this is something you don't know this, know it now for the rest of your life. Maybe when you're 92 in the nursing home, you can forget it at that point, but everybody in finance knows this. So let's see how many periods we have. So there's 938 periods. So a CAGR equals the ending value divided by the beginning value raised to the 1 divided by the number of periods minus 1. Now here, the number of periods is the number of growth periods. So this CAGR is a little bit different than what we're going to do with the geometric linking. It looks like there's 938 periods, but there's only 937 growth periods because you grow from here to here, you grow from there to there, there to there. So our number of periods is actually 937. So I'm going to take the ending value divided by the beginning value. Now I'm going to raise it to 1 divided by 938 minus 1. In your case, you don't do the minus 1 because this is an index. We'll see that. Minus 1. So there's your average monthly inflation, 0.29%. But most people think in annual terms. How will we annualize this? Instead of taking to the 1 over 937, you take it to the 12th. These are monthly numbers, right? So inflation, average inflation, the last how many years? The last 78 years, inflation has averaged 3.52%. Okay. Use CAGRs. Anytime you're looking at how one thing grew to another. And we could say inflation is up. You can tell your boss, yeah, inflation is up 1,400% since 1940. Most people can't think in those terms. You tell your boss, inflation's averaged 3.5% since 1940. That we can do something with, right? So this is the CAGR. What does CAGR stand for? Anybody know? What's the first one? Compound. What do you think the A is? Annual. G. Growth. Rate. CAGR. We don't say we don't say annualized compound annual growth rate. We say CAGR. So make sure you know CAGR. We use it so much in finance. It's really quite powerful to use. You could do that with the economy. You could bring in GDP today, divide it by 50 years ago, take it to there it's quarterly, so you have 4 numbers. So you would take it to the 4 over however many periods there are, and that -1, that would give you, so you can do it with all kinds of data. It's really quite powerful. So what we're doing here is we're taking each one of those holding periods and we're linking them together. We're making that index that I just showed you, right? So that inflation index was already all those things all compounded together. Here we're going to take our compounding, and so you remember with inflation, I did it the number of periods -1. Here we really do have 4 periods. Our first period is 1. We're going to say, what if we had $1 and then we made the holding period return the first month? We made the second period as holding period. How much would that $1 be worth at the end of 3 periods? All right. So we'll do some practicing. The only thing you have to do on the exam, which is really simple, is I'm only giving you 3 months because we don't have much time on the exam. And then we're annualizing that. According to the CFA Institute, you can't annualize periods that are less than a year. So I'm asking you to do something exam that's not allowed. So you have to put the footnote and say, according to CFA Institute, we can't annualize periods less than 1 year. But we're going to do it. Now, if you use Bloomberg, they have the geometric numbers, and they do annualize shorter periods without the footnotes. So they don't quite get it right. You all know which number is always higher between these two numbers, arithmetic and geometric? So arithmetic is always the higher number. The geometric is going to equal the arithmetic minus half of the volatility, or half of the standard deviation squared. Why is the geometric lower? Because of volatility. Let me prove this to you. So you invest for your uncle gives you $100,000. And he says, hey, you're a UTSA investment person, go invest for me. So there's your time 0. At the end of time 1, the portfolio is worth $150,000. Your uncle's like, wow, you're really, really, really good. At the end of time 2, portfolio is worth $75,000. You say, let's figure out the returns. So the first thing we have to do is the holding period return. We can't do a holding period return for time 1 because we need a beginning and an ending number. Here we only have a beginning number. So here we're going to do the holding period return. We can take the ending market value minus the beginning market value divided by the beginning market value. That's 50%. And then we do the same thing for the next one. We take ending market value divided by beginning market value divided by beginning market value. I meant to say minus. And let's calculate. And so you tell your uncle, remember your arithmetic return is, you just add the holding period returns together, divided by the number of periods. How many periods do we have? 2. Tell your uncle, hey, you gave me $100,000 and my average return was 0%. And he looks at his statement, and what is he saying? Yeah, where'd you go? You go to A&M or what? I don't get that. How can you say you made me 0% average return if I've got 25,000 less dollars? But let's do the geometric. So for the geometric, we have to do 1 plus the first period. I'm going to give extra parentheses. 1 plus the first period times 1 plus the second period raised to the 1 divided by the number of periods minus 1. That gives me an average annual return of negative 13. Which of those numbers do you think our uncle's going to buy? The second one. He's not going to trust the first one, but these are both accurate. This one is the best one for forecasting. So if you wanted to say, what's the likely return next month? Your best forecast is 0%. But this one is good for historical performance. So if you want to know how you actually did, the geometric is the best one. That's what I use on my portfolio home. I use the geometric because I want to know how I actually performed. But if I wanted to forecast my portfolio, I would look at the arithmetic average. All right. So those are the difference in the two. Why is there such a big difference in this? Because this was really, really volatile. And I'll show y'all some numbers on this. So let's try Dutch boys. Since I'm in there. Let's calculate Dutch boys. Bros. Let's do February, January, December. So February's ending market value is 79.16. January's ending market value, 62.52. December's 52.38. And then November, 53.73. Wow, did you know y'all on this stock? So there's the closing. What about dividends? Do you think they pay dividends? There are no dividends. So this one, no dividends. We don't have to worry about the accrued income. So let's do the returns. So first thing you do is a holding period return. So remember, the holding period return has nothing to do with arithmetic and geometric. It's the same between the two. So remember, for holding period return, we're going to take, whoa, what did I just hit? I got Zoom messing up. So remember here, got ending market value minus beginning market value plus income divided by beginning market value. Here we have no income, so we don't have to worry about it. So our ending market value is February's minus January divided by January. So they were up 26% in February. January, you've got 69.52 minus 52 divided by 52. You got 19%, and then a small loss this last month, 52 minus 53 divided by 53. So you do that first, get your holding period returns. Okay. Then you got to calculate the arithmetic and the annualized. I have a real strong feeling this isn't right. Arithmetic and annualized. So the arithmetic, all you have to do is add 27% plus 19% plus minus 3% and divide by what?
3.
By 3. There's 3 months. And then what is your annualized? You just take that times what? 12, because it's 12 months. If it was weekly, it'd be 52. And then you put a footnote in there. If an institute does not allow periods for less than a year to be annualized. So just put that footnote in there and you got it. So there you got full credit for the arithmetic. Arithmetic's the simplest, most straightforward. Now let's try geometric. So this one's a little more complicated. We have to practice this on your calculator because you don't get Excel on the exam. Practice on the calculator. So we'll do 1 plus the first period, which is, I guess, first period minus 3. Doesn't matter which order you do it in, but 1 plus the second period. So essentially what we're asking is, what would $1 be worth if you took that dollar and lost 3%, then made 19%, and then made 27%? And we wanted to take the average of that, so we're going to do it 1 divided by 3. All right, remember with a CAGR, it's 1 divided by the number of periods minus 1 because it's growth periods, because that's an index. But here, we're doing it as 1 divided by 3 minus 1. So there's our return. And then we annualize it. The exact same formula again, except for instead of doing 1/3, we do 12/3. It is possible for the annualized to be higher than the arithmetic or the geometric, but the monthly geometric has to be lower than the arithmetic. It has to be mathematically. If there's any volatility at all, it has to be lower. All right. We'll get a lot of practice on this. We may not have a team question on this. We might have next week. We'll see with the exam, maybe not. But yeah, I mean, as a finance major, you really need to understand how to calculate returns. Arithmetic's what you're going to use if you're doing some kind of forecasting model. Geometric is what you're going to use. You're trying to figure out what your actual return is. We use them all the time. Huh?
Okay, you explain that then, on the geometric, when you do the -1 and when you don't.
Well, you always do the -1 with the geometric. All right, when I did this, you always do the -1. Because what it's saying is, you started with $1. If you don't do the -1, you still get that. It's almost like you made the dollar again. You got to subtract it out because that's what you initially invested, was $1.
Is that the -1 of the power of 1 divided by n?
No, this one is that something different. So the difference here is, you can see here I have percentage changes. If I were looking at the percentage, so I could do this. I could do that divided by that, raised to the 1 divided by 4 minus 1 minus 1. And that's going to give me the same answer, right? Because I started with 53, but there aren't 4 periods here. It's how many times it grew from here to here, that's 1, grew from there to there, that's 2, grew from there to there, that's 3. So if you're doing an index, you're doing an amount, you do it to the period minus 1. If you have actual changes, you don't need to do -1 because you're doing the changes. So it depends if you're using an index or using percentage change. All right. Our purposes, we won't be doing it like this. We'll be doing it like this. So you just raise it to 1 over 3. You don't need to subtract 1 at the end there. All right. So let's practice this again, but with a little bit more data. Oh. Historical data. Prices monthly. Let's go back to Max. I'm going to try to bring this in. Yahoo Finance really messed this up. They used to have this where you could do it for free. They used to have a download button over here, and they took all that out. You can see you got the little, so it's such a pain that they did that. So let me show you what you actually do in real life. First of all, I'm going to resort it. So we'll start earliest to latest. All right. So the first thing you do is you need a holding period return. All right. whether it's 3 months or 20 months or 5,000 months, you need a holding period return. We can't do the first month, right? Because there's no beginning. So we do ending market value minus beginning. Wow, they had a really good first month. Oops. Divided by beginning. 76% in their first month. That's a decent start. How do we copy this down? Anybody know?
So it looks like a-
Yeah, if I see y'all doing this, it gives me a heart attack. All right, so there's their monthly returns. Doesn't matter if we're doing arithmetic or geometric, it doesn't matter. All right, well, let's do the arithmetic. There we just do the average. That's all arithmetic is. It's just the average. So their average return is 3%, 2.8%. That sounds really low, but this is monthly. All right, so if we annualize it, what do you do there? Yeah, just multiply by 12. Do we need the footnote here?
No, because it's more than.
Yeah, it's more than a year, it's several years. So no footnote needed here. Then the geometric. This one gets a little tough. So essentially what we're saying with the geometric, let's say we assume we started with $1 and we take that $1 and the first month we make 76%. So end of the first month, we're gonna have $1.76. At the next month, we're gonna take that $1.76, not the dollar, but the $1.76. We're gonna make a 31% loss on that. So now we're down to $1.21. We're just gonna keep doing that all the way to the end. So that $1 that we had invested would be worth $1.45 today. All right. So how do we do the geometric? So the geometric is this number right here. That's our linked. So we're going to take that number. We gotta figure out the number of periods. So we have 42 periods. Because I mean this is actually 42 periods. It's 43 if we count our $1 that we originally started with, but it's 42 periods. Yeah, sorry. All right, so get the geometric. We're going to take that linked number divided by 1 and raised to the 1 divided by 42 minus 1. We get 0.9%, much lower than arithmetic. And how do we annualize that? The same way, same formula, you just take that and make it 12. That can be higher. Now the geometric looks awfully low to me, so I'm worried that there's some error somewhere in here. I don't know where it would be. It looks correct to me. It may just, so let's see, let me check and see if we can figure out why it's so different. So we can test it. The standard deviation of their stock price is 21.13. So let's just try it. So we said the geometric should be the arithmetic minus 0.5 times the standard deviation squared. It's a little bit off. This is a stock that's so volatile. Why would it be off? It would be off if the stock price is not normally distributed. If the stock price is skewed one way or the other, you're going to get it. But generally, and usually it works really well. Generally, if you calculate the standard deviation, you can get from the arithmetic pretty close to the geometric by subtracting 1/2 of the volatility. But in this case, I picked a stock that's just too new and too volatile. But this is powerful stuff. It's really, really helpful. This annualized return is essentially how they actually performed, 11.3%. Another way you can think about this is if you started with $1 and you made exactly 0.9% each month. Oops. Look at your ending value. Looks real similar, doesn't it? $1.45, $1.45. That's what that geometric is telling you. If you make exactly 0.9%, you'll end up with that ending stock price. It's that return that gives you that ending value. All right. So it's another word you might have thought of is IRR. Essentially, that's what it is. It's the IRR for this investment. So, all right, let's try another one. What time? Yeah, we can do another one. Let's do a little bit more normal firm. Let's try Apple. Now, challenge we're going to have is when stocks pay dividends, you really want to use the adjusted close. What the adjusted close does is when a stock pays a dividend, it impacts the stock price. And what the adjusted close does is it adds that dividend back in. And so as you go back further in time, the stock price adjusted is lower than the actual stock price because they're essentially giving you that 25. So you can get an actual true return. So we'd prefer to use the adjusted close here, but Yahoo Finance has really made this difficult. But let's try this. I've got monthly. Yeah, it's going to be, I tell you what, I'm not going to do that. I'm going to do Google. Google's much easier. Because they don't pay dividends, right? Makes it much easier. So firms pay dividends. We'll work more with dividends as we get into it. But okay, come on, you can do it. Where's the numbers? There it goes. All right. And again, we want monthly. One thing I will tell you, oh, they are paying dividends now. Wow, word. Who's a stock that's not paying dividends? I think NVIDIA pays a dividend. Have y'all seen NVIDIA's dividend? You want to look at a really stupid dividend? This is 100. Oh, that's not up there yet. Oh, come on, y'all. Who timed out? How can you time out? Yeah, this is $117 stock that's paying a 1 penny dividend. Why are they doing that? I don't know their logic. It's almost insulting, right? You own 5 shares and they send you a nickel. Anybody's like, oh, I got a nickel from NVIDIA today. So I don't even know why they're even bothering to do that. It's so bizarre. Let's do monthly. All right, so if I do this, let's do the max. I still got a dividend in there, so it's still going to mess it up. But anyway, we'll go back to February. And I'll just copy as much as I can in. We'll have to take those dividends out. We know NVIDIA is a high returning stock. So let me get rid of the dividends real quick. You see what happens, when they do stock splits? See how small they've done some pretty significant stock splits. So you really can't use these early periods. It used to be Yahoo Finance when you get downloaded. These early periods wouldn't be 4 cents. They would be 0.043216439. You could actually use them. But because now you have to pay for the data, it's only 4 cents. So it doesn't make sense because it looks like the stock price didn't move at all, but it probably moved 10 or 20%. So we got to get rid of these periods of time. I usually start somewhere around where it gets to be $1. Just so we have a little bit more accurate data. All right, so what's the first thing we do? HPR. So we take ending market value minus beginning divided by beginning. 22%, pretty decent month. Copy that down. Number of periods. $104. So we do the arithmetic. And here we can just use the equal average function. And that's a pretty crazy monthly return. If you can make that monthly return, you make $100,000, you invest $100,000, and you make 1.056 over the rest of your career, how much money would you have? You can make, would you like to make 5.6% a month the rest of your career? How much would that be worth? Let me divide by 1 billion. You'd be a really rich person. Let me divide by 1 trillion. There you go. Oh, it's got it as a date. So you'd have, well, what comes out a zillion? You have 22 zillion. You'd be a really, really rich person. I saw a commercial, they were advertising some trading platform, and the woman in the advertising said she made 8% a week without risk. It's like, if that's the case, you will own the entire world in a very short period of time. So yeah, there's no way NVIDIA is going to keep making 5.6% because it becomes so massive, it would overtake everything. So this is just a period of time with stock, and obviously it's a bunch. And then you annualize that, just multiply that by 12, which is kind of a ridiculous number too. And then we do the geometric length. So let's say, well, we started with $1. We take that dollar in the first month, we make 22%. We cop that down. So that $1 will be worth $108 in that period. That's pretty impressive. So if we do the geometric, we just take that 108 and raise it 1 divided by 104 minus 1. And again, it's going to be lower. Let me get the standard deviation. I think it's going to work this time. NVIDIA is not quite as wild as brothers. So their monthly standard deviation is 14%. So if we take the arithmetic minus half of the standard deviation squared, pretty close, right? So why is the geometric lower than the arithmetic? It's because of volatility. The more volatile it is, the bigger difference. Why? Because if you lose 50%, you've got to make 100% to get back to where you were. If you lose 10%, you have to make 11% to get back to where you were. So the more volatile it is, the more further away those two numbers are. Losses hurt you more. And then we annualize this. The exact same formula again, except for we do it to the 12th. And here you can see it can be higher, all right? When you annualize it, it can, especially with big numbers like this. So the monthly number can't be higher, it has to be lower, but the annualized numbers can be because you're compounding it, all right? I'll show you examples from the exam probably on Monday, we'll do some practice on that. But you definitely need, as a finance major, you definitely need to understand arithmetic and geometric averages. You definitely have to know what a CAGR is because we use them all the time in finance. It's pretty important. So we'll talk about risk, getting the risk. Oh man, we got 10 minutes. So I'm scared to ask you all this question, but we'll try it. So there's 4 formulas every finance major should know off the top of their head. Standard deviation, correlation, R squared, and beta. How many of those 4 do you know off the top of your head? Anybody remember standard deviation? You remember? Well, okay, so what is variance? All right, so let me real quickly, we'll do this again. I'm almost tempted on the exam. These formulas are extremely important. You should have them not memorized. You just know them because we use them so much. If your stats professor gave you formula sheets, they messed up your life because you need to know these formulas. But the good news is they're almost identical, same formula 4 times. So step 1, you take a difference. Step 2, you multiply. Step 3, take an average. And then step 4, something else. So what do I mean by an average? For standard deviation, your step 1 is you take x minus x bar. What is x minus x bar? X bar is what? Minus the mean, right? So how do we do that with NVIDIA? Our average is 5.6%. So you start off 21% minus 5.6, 7.9 minus 5.6, 11.9 minus 5.6. You start off with a difference. All right. Why is that so critical in finance? There's like 98% of finance is sitting right there. How do we define risk in finance? How far you can get from the average. What's the other thing we call the average? Y'all know what's that term they use? The mean, we also call it what? The expected value. We define risk and how far you can get from the expected value. All right. Correlation, you do the exact same thing. X minus the mean. But you also, for standard deviation, you only need 1 data series. For correlation, R squared and beta, you need 2 data series. So you're going to do Y minus its mean. All right. And guess what we do for R squared and beta? The exact same thing. So correlation, R squared, and beta, they start exactly the same way. All right. Have y'all heard of the term covariance? So we'll look at covariance. We haven't done it yet, but correlation, R squared, and beta all start with covariance. And then the last step is slightly different. All right. So if you know that. So the first thing we do is a difference. The second thing we do is multiply. Or for standard deviation, we take x minus x mean and multiply by x minus mean, the mean of x. We square it. All right. So in standard deviation, you just multiply it by itself. What happens to negative numbers when you do that? It disappears. So the definition of risk in finance is not how much money you lose. It's how far you can be from the expected value. So we say something's risky. You can tell your uncle this. Hey, uncle, we were expecting to make 5%, but you made 50%. So this is really risky. Your uncle's going to say, that doesn't sound risky at all to me. But in finance, we say, hey, if you can make 50% when you expect 5, why is that risky? Because what else could you do? You can lose 45% when you expect 5. So standard deviation doesn't care if you're above or below. Now, is there a measure in statistics that does care? Yeah, that's called what? Semivariance. We don't use semi-variance very often. Semi-variance just looks at when you're below the mean, how far you're below the mean. So that's semi-variance. Markowitz, and when he got the Nobel Prize for efficient frontier, he actually wanted to use semi-variance, but the calculations were really tough before computers, so he went with standard deviation. So there are measures of risk which ignore above the mean or look at below the mean. All right. With correlation R squared, what do we do here? We just multiply these two things together. But we still multiply, right? Step one, difference. Step two is multiply. Do negative numbers come in here? Absolutely. Do you see what's going on with covariance? It's asking when this is above its mean, is this one also above its mean? If they're both above their mean at the same time, you get a positive number. If they're both below their mean at the same time, you get a positive number. When you get a negative number, well, one's above when the other one's below. So here, negative numbers make it important. And the key, some people say correlation is how two things move together. That's not correct. Correlation is how two things move versus their mean versus each other. It's possible you can get a negative number even though these are positive returns. So this could be 2% minus 1%. This could be 2% minus 3%. They could both be making 2%. But the question is not, are they both 2%? The question is, where are they versus their means? All right, so that's real key there. The next thing you do is the average. All right, that's pretty simple. Anybody know what this is called? Hint, hint, I've already told you. That is the covariance. All right, multiply divided by n, that's the covariance. Okay. And then what's the last thing you do? So was it Emilio that gave me this? What's the last thing we do? Take the square root. Who said that? Someone over here. So yeah, standard deviation. So this is the variance, right? You take the square root of the variance, you get standard deviation. Okay, pretty simple formula. What do you do here? Well, with correlation, you divide it by the standard deviation of x times the standard deviation of y. You just multiply by the standard deviations for r squared. It's just correlation squared. So it's this, then you square it. Correlation can be -1, +1, 0. R squared can be 0 to +1. It can't be negative. And what do we do with beta? So beta, if y is the market, and it's the standard deviation of y, it's the standard deviation of y, if y is the market. You should know these formulas, all right? See how simple they are? This seemed a lot simpler than what you remembered. You get so into the weeds, it's really simple. Difference, multiply, average, and then make that last adjustment. There's so much finance in these formulas that you really should know the formulas. They're all very sensitive to outliers. So if you have one really wild period of time, it can skew these quite dramatically, especially with standard deviation, because you're squaring these things. When you square big numbers, you get a much bigger impact. All right, we'll talk about this more, but you should definitely know this. All right, I'll stop it there.